Stop everything for a moment and listen closely, because what I'm about to share could be the most crucial financial insight you encounter all year. I've spent over 20 years observing global capital markets, studying every major asset class through bull markets, bear markets, currency crises, debt collapses, banking panics, geopolitical shocks, and inflationary spirals. I've seen how institutional money behaves when conditions turn truly dangerous. And right now, in the spring of 2026, I'm witnessing something unprecedented in both scale and speed. The world's most sophisticated, globally connected pools of capital are quietly, deliberately moving into gold. Not making headlines, not issuing press releases, simply shifting substantial sums of money with precision. This is how informed money operates, always ahead of the broader market, and it's exactly what is happening right now. This isn't a speculative theory or wishful thinking about a shiny metal. What I'm sharing is pattern recognition built on decades of observing institutional behavior when those controlling vast sums of capital believe the rules of the financial system are changing. The pattern we see today is one of the clearest and most compelling signals I've encountered in my career. Picture this scenario. You manage $50 billion for a sovereign wealth fund with teams of economists, currency analysts, geopolitical strategists, and central bank watchers working around the clock. You see private data and conversations that won't reach public awareness for another 6 to 12 months. Using that intelligence, you quietly start moving a meaningful portion of your portfolio into physical gold, not ETFs, not mining stocks, but actual bullion stored outside traditional financial institutions. You don't hold a press conference. You don't release research notes. You buy consistently, quietly, week after week, before the price reflects what you know. That is precisely the behavior taking place today. By the time the average investor notices, the easy gains will have already been captured. The signals driving this shift are clear. Central banks are purchasing gold at rates unseen in over 50 years. This is not minor portfolio tinkering. It's the largest sustained central bank gold accumulation in decades. In 2022, central banks bought over 1,000 tons, the highest annual total in half a century. In 2023, nearly 1,000 tons were added again. In 2024 and 2025, these elevated purchases continued. These are institutions managing trillions in foreign currency reserves, moving deliberately and with access to intelligence far beyond the reach of individual investors. When they buy at record pace over multiple consecutive years, it's not because of bullish charts. They are responding to fundamental changes in the global monetary system and acquiring the asset that has served as a reserve for 5 millennia gold before the rest of the market catches on. Consider this carefully. If the institutions managing entire nations' reserves are shifting toward gold, what do they see that the average investor does not? What are they observing in the global financial system that motivates them to reduce exposure to paper currencies and increase allocation to physical metal? To answer this, we need to look at the pressures facing the dollar system today. The global monetary framework established after World War II was built on the US dollar, which serves as the world's reserve currency, the settlement medium for global trade, and the pricing basis for commodities like oil. This arrangement, often called dollar hegemony, has given the United States extraordinary benefits, allowing it to run deficits and issue debt in its own currency with unmatched freedom. But that system is under strain on multiple fronts, and the stress is intensifying. First, the scale of American debt is staggering. The United States federal debt exceeds $36 trillion, with annual interest payments alone surpassing the entire defense budget The Congressional Budget Office projects that debt will continue growing faster than the economy for the foreseeable future. And in today's political climate, no plausible scenario exists for reversing this trajectory without significant repercussions for the dollar's value. Second, the weaponization of the dollar has changed the calculus for central banks worldwide. In 2022, the United States and its allies froze approximately $300 billion of Russian central bank reserves held in Western institutions. For decades, dollar-denominated assets were considered safe, liquid, and politically neutral. That event signaled to every non-allied country that dollar reserves are not fully secure if political circumstances shift. The rational response is to diversify away from dollar assets and into something impervious to confiscation or freezing physical gold. Third, alternative trade settlement systems are emerging. The BRICS nations, Brazil, Russia, India, China, South Africa, and other countries are gradually reducing reliance on dollar-based infrastructure, reshaping global financial dynamics. These forces are significant individually, but together they create a structural tailwind for gold unlike anything seen in decades. When central banks outside America's geopolitical orbit witness exploding U.S. debt and observe the sudden freezing of foreign reserves, physical gold becomes the logical choice. It is outside the dollar system, immune to counterparty risk, impossible to confiscate, and universally recognized as a monetary reserve. This is exactly why smart money is moving in quietly and steadily. Beyond central banks, large institutional investors, sovereign wealth funds, family offices, macro hedge funds are repositioning their portfolios into gold at a pace designed to remain invisible to the broader market. They accumulate discreetly to avoid pushing the price prematurely, only to reveal the move when the market fully appreciates the shift. Their motivations are multifaceted: falling real interest rates, uncertain equity valuations in a high debt, low growth world, and potential systemic banking crises that could devastate traditional portfolios. Gold in these conditions is not speculative. It's a strategic store of value. The price chart of gold confirms this pattern. Recently, it set new all-time highs, breaking out of a multi-year consolidation. Analysts treating this as an anomaly are missing the fundamental flows underpinning the move. The secular uptrend is confirmed by consistent institutional support, suggesting a sustained, structurally driven rise rather than a short-term spike. Historical precedent reinforces this. Investors who recognized the structural forces behind gold in the early 2000s captured massive gains over the following decade, while those waiting for a comfortable entry missed most of the profit. The lesson is clear. When deep structural forces align, waiting for perfection often costs the majority of potential gains. Warning signs are also emerging. The divergence between paper and physical gold, rising premiums for immediate delivery, geographic shifts from Western to Eastern financial centers, and understated central bank accumulation all point to a profound, ongoing reallocation. These signals reinforce the urgency to position oneself ahead of the wave. The warning signs I just mentioned are signals that every serious investor should take note of. They aren't random anomalies. They are patterns that have historically preceded major gold revaluations. First, the divergence between paper gold and physical gold is telling. Paper gold futures, ETFs, and other financial instruments offers exposure without actual ownership. Physical gold, actual bars and coins, is the asset that cannot be frozen, confiscated, or suspended. Recently, the premiums for immediate physical delivery have been rising, reflecting strong demand, while gold has quietly moved from vaults in London and New York to safer locations in the East. This is a geographic and strategic shift, showing where wealth and economic power are quietly relocating. Second, gold mining stocks are beginning to outperform the metal itself. Historically, mining equities lead gold prices during sustained bull markets because investors price in future profits based on expected higher gold prices. The fact that these equities are now moving ahead signals that institutional players are making forward-looking bets on significant price appreciation. Third, the physical movement of gold from West to East London, New York to Shanghai, Mumbai, Dubai, reflects geopolitical realignment. Countries that are diversifying away from the dollar are actively accumulating physical gold in safe, secure locations. Finally, central banks' official reporting often understates the true scale of accumulation. Analysts tracking these flows suggest that actual purchases are far ahead of what official numbers show. In short, the structural shift toward gold is well underway and may be larger than public data indicates. Now, the critical question becomes, what should an individual investor do in response? If this analysis has sparked concern or urgency, that reaction is appropriate. It should translate into deliberate action because the window to position yourself before the broader market fully realizes the implications is limited. Step one is understanding the difference between paper gold and physical gold. ETFs and futures provide exposure to price movements, but in a systemic crisis, they carry the same risks as other financial instruments. They can be frozen, suspended, or subject to emergency regulatory action. Physical gold in your direct possession offers complete protection from these risks. It cannot vanish due to a bank failure, regulatory intervention, or market freeze. If you are buying gold as a hedge against systemic risk, ownership of the physical asset is essential. Step two is sizing your position appropriately relative to your overall portfolio. No one should put everything into gold. Diversification remains critical. Institutional data and macro investor behavior suggest that a range of 10 to 20% of a serious portfolio in physical precious metals provides both protection and upside. This allocation allows meaningful participation in the move without exposing your entire net worth to a single bet. Step three is storage. Physical gold held at home in a high-quality safe or in a private non-bank vault ensures access and security. Bank-safe deposit boxes, while seemingly convenient, carry the risk that access could be restricted during financial stress or regulatory intervention. Gold held outside the traditional banking system avoids this risk entirely, offering you immediate and absolute control over your asset. Step four concerns timing. Gold moves in cycles, even within broader structural trends. Dollar cost averaging, spreading purchases over 3 to 6 months rather than making a lump sum acquisition allows you to build a position without overexposing yourself to short-term price fluctuations. The structural drivers behind this move dollar system stress, central bank behavior, geopolitical realignment are measured in years, not weeks. Perfection and timing is less important than consistency and discipline. Step five reframes gold as insurance rather than speculation. Like any insurance, you purchase it not because you expect disaster, but because if disaster occurs, the cost of being unprotected is catastrophic. Owning gold in today's environment carries a modest opportunity cost relative to stocks or bonds, but failing to have it if systemic risks materialize can be financially devastating. This asymmetry, the low cost of being prepared versus the potentially enormous cost of being unprepared, is the foundation of the investment case for gold right now. Some may worry that gold has already moved significantly and that buying now means entering late. This is a natural concern, but it misunderstands how structural bull markets in gold unfold. In past cycles, early gains occur quietly, driven by informed institutional accumulation, while retail investors wait for more comfortable entry points. When the market finally recognizes the trend, the move accelerates, producing larger absolute gains in the second phase than in the initial rise. Today, we are in what I assess as the early to middle stages of this bull market. Central bank purchases are accelerating. Institutional repositioning is broadening, and structural forces like dollar stress, geopolitical shifts, and financial system fragility are deepening, not easing. History suggests that waiting for perfect conditions often results in missing the majority of the upside. The lessons from previous decades are instructive. Investors who hesitated during the early 2000s, waiting for lower prices after gold had already begun its move, missed most of the gains in a decade-long bull market. While no two cycles are identical, the structural similarities between then and now are striking. Dismissing the current move as already too late ignores the underlying forces that are driving sustained appreciation. The most common regret I see among investors is not acting decisively when the evidence is clear and prices remain reasonable. Waiting for the ideal entry point, which may never appear, often leaves one on the sidelines as the asset continues its rise. Beyond individual gains, the broader macro context underscores the importance of positioning. Extreme government debt, constrained central bank policy, geopolitical realignment, and systemic fragility combine to create an environment with few modern parallels. Smart money isn't buying gold out of pessimism. It is buying because it understands that in times of systemic uncertainty, an asset outside the financial system, impervious to central bank debasement and governmental freeze, is a rational, prudent component of any portfolio. Gold has preserved value for 5,000 years precisely because it operates outside the systems that fail under stress. The current convergence of structural forces, institutional behavior, and market signals presents a unique window to align with the most informed money in the world before the broader public recognizes the implications. Part 2 concludes here. But the story continues. The next segment will delve deeper into the specific indicators signaling gold accumulation, the subtle yet powerful flows of institutional capital, and the historical patterns that show just how significant this moment is. By understanding these factors, you'll be positioned not merely to observe the market, but to participate intelligently with foresight and clarity. The structural, geopolitical, and financial drivers at play aren't temporary. They are reshaping the very foundation of global wealth management. Recognizing these patterns early is the difference between passive watching and active, informed positioning. Now that we've laid out the warning signs and the steps for individual positioning, it's crucial to understand the deeper patterns and signals that institutional investors are following, the subtle flows and technical cues that most retail investors completely miss. This is where the real insight lies, because it shows not just what has happened, but what is likely to happen next. Let's start with the gold price chart itself. Many observers glance at it and assume gold is simply volatile or boring. But if you know how to read it properly, the story is quite different. Over the past several years, gold has steadily climbed, punctuated by periods of consolidation but with a clear upward trajectory. Recently, it broke through multi-year highs that many analysts thought were unreachable. That breakout is significant. It's not driven by hype or short-term speculation. It is backed by structural, persistent demand, primarily from institutions and central banks. The chart is confirming what the capital flows have already been signaling. Gold is now in what analysts call a secular uptrend, which in plain language means a long-term structural increase rather than a temporary spike. When a market enters a secular uptrend, corrections and pullbacks are normal and healthy, but they do not change the long-term direction. In prior cycles, such moves have often lasted a decade or more, delivering gains that far exceeded initial expectations. Consider the period between 2001 and 2011. Gold started near $300 an ounce, quietly accumulated by informed buyers, and over 10 years, it rose above $1,800. The vast majority of retail investors missed most of that move because they waited for a perfect entry. This historical lesson is relevant today. The forces driving the current trend, central bank accumulation, geopolitical realignment, dollar system stress, are structural, not cyclical. Waiting for ideal conditions often means missing the majority of the upside. Institutional flows offer another critical layer of insight. Smart money does not act randomly or publicly. Sovereign wealth funds, multi-generational family offices, and macro hedge funds move quietly, deliberately, and consistently. They add positions slowly over time to avoid alerting the broader market. When they believe a structural shift is occurring, the accumulation is methodical. The current pattern shows broadening institutional participation. Not only are central banks purchasing record quantities, but hedge funds and private institutions are quietly building positions in physical gold. This coordinated yet silent action is exactly what preceded previous bull markets. The lesson is clear. The price of gold today reflects only part of the demand that is already in place. Much more upside may come as the broader market catches on. Another subtle but telling signal is the divergence between paper gold and physical gold. Futures, ETFs, and derivatives are convenient for trading, but they are subject to counterparty and systemic risks. Physical gold, in contrast, cannot be frozen, confiscated, or otherwise compromised. Lately, premiums for immediate physical delivery have been rising, especially in markets like Asia and the Middle East, showing that actual metal is moving in significant quantities. Vaults in traditional Western financial centers are increasingly seeing outflows, while gold is quietly moving to Shanghai, Mumbai, and Dubai. This movement is both strategic and symbolic. It reflects a fundamental shift in economic gravity, with the East accumulating tangible wealth outside the traditional dollar-based financial system. The behavior of gold mining stocks is another early indicator that professionals follow closely. Mining equities often lead the underlying commodity during a sustained bull market. Rising mining stocks indicate that investors are anticipating higher gold prices in the future. This outperformance is already underway, signaling that institutional money is not just buying gold passively, it is pricing in expected structural gains. In other words, these investors are seeing beyond current market prices and positioning themselves for what comes next. Geopolitics also reinforces the case. As I mentioned previously, non-Western nations are seeking to reduce dependence on the dollar. They are diversifying reserves and actively accumulating physical gold to protect against currency risk and geopolitical interference. The 2022 freezing of Russian reserves was a watershed moment. It demonstrated that even supposedly secure dollar-denominated assets could be immobilized by political actions. The rational response from any non-aligned central bank is to diversify into assets outside the financial system, and gold is uniquely positioned for this role. Its security, tangibility, and historical function as a reserve asset make it irreplaceable in times of systemic uncertainty. Now, let's discuss the intersection of these structural forces with interest rates and inflation. Real interest rates, nominal rates adjusted for inflation, are critical for gold prices. Historically, falling real rates have been one of the most reliable drivers of gold appreciation. If the Federal Reserve faces conflicting pressures, maintaining inflation control while avoiding financial system stress, real rates may decline significantly. Lower real rates reduce the opportunity cost of holding gold relative to bonds, making the metal increasingly attractive to institutional investors. This is another factor that reinforces the ongoing accumulation and supports the secular uptrend. Finally, we must consider financial system fragility. Since 2022, banking stress has been building, and the potential for systemic shocks remains a concern. In such scenarios, physical gold is one of the few assets that consistently performs well because it operates independently of traditional financial mechanisms. Unlike cash or bonds, gold cannot be diluted, frozen, or compromised by institutional failure. This gives it a unique resilience that becomes especially valuable in periods of uncertainty. Taken together, these structural, technical, and geopolitical indicators paint a clear picture. The forces driving gold are deep, persistent, and unlikely to reverse quickly. This is not a speculative fad. It is a strategic accumulation based on decades of experience, global intelligence, and systemic insight. The implications for the average investor are profound. Understanding these flows, reading the chart correctly, and recognizing the structural drivers provides a level of foresight that is often absent from mainstream commentary. Part 3 concludes here, but the narrative continues. Next, we will analyze the timing and strategy for entering the gold market, including practical steps for building a position, managing risk, and ensuring that your approach aligns with the moves of the world's most sophisticated investors. We will also explore how these signals interact with other asset classes and what historical precedent tells us about the potential scale and duration of the next phase in the gold bull market. Now that we understand the forces driving gold, the flows from central banks, and the signals from institutional investors, it's time to focus on what you should actually do if you want to position yourself alongside smart money. This is where theory meets action, and it's critical to approach it deliberately. Timing, allocation, storage, and mindset all matter. Gold isn't a speculative play. It is insurance against systemic risk. And the window to establish meaningful positions before broader market awareness catches up is open, but not for much longer. First, distinguish between paper gold and physical gold. Paper gold, ETFs, futures, derivatives, offers exposure, but carries the same systemic risks as other financial instruments. In a genuine crisis, these instruments could be frozen, suspended, or otherwise restricted. Physical gold, on the other hand, is tangible and exists outside the traditional financial system. Bars and coins held in your possession or a secure non-bank vault are immune to such risks. If the purpose of your gold allocation is protection against systemic uncertainty, then only physical gold provides that security. Second, consider position sizing relative to your overall portfolio. You do not want to overexpose yourself, but you also don't want to underprepare Historical data on institutional allocations suggests a meaningful position ranges between 10 and 20% of your investment portfolio. This balance allows for both protection and upside participation without concentrating risk excessively in a single asset. Even at the lower end of that range, physical gold offers insurance that can mitigate the impact of severe market dislocations. Allocating too little means missing the protective benefits. Allocating too much is unnecessary risk concentration. Third, storage is a critical factor. Where your gold is held matters just as much as how much you hold. A high-quality home safe or a private non-bank vault provides maximum security and immediate accessibility. Safe deposit boxes in banks carry hidden risks. If your bank restricts access due to regulatory or systemic issues, you may not be able to access your holdings when you need them most. A trusted, independent storage solution ensures that your physical gold is genuinely yours and available under any circumstances. Fourth, think carefully about the timing and method of accumulation. Gold moves in cycles within a broader secular trend. A disciplined approach, such as dollar cost averaging over 3 to 6 months, allows you to build a position steadily without being overly concerned about short-term price swings. The structural forces driving this bull market are measured in years, not days or weeks. So perfect timing is less important than consistent, deliberate accumulation. Spreading purchases across time also reduces the psychological impact of volatility, helping you stick to your plan. Fifth, shift your mindset from speculation to insurance. You do not buy insurance because disaster is guaranteed. You buy it because the potential cost of being unprepared is catastrophic. The same principle applies to gold in the current environment. The downside of owning gold, if systemic risks do not materialize, is modest. Some opportunity cost relative to equities, some foregone interest relative to bonds. The downside of not holding gold, if those systemic risks do materialize, could be severe, potentially devastating to an unprepared portfolio. That asymmetry, the low cost of preparation versus the high cost of inaction, is the essence of the investment case for gold today. Next, let's address a common concern. Hasn't gold already moved? Isn't it too late to buy? This is understandable. Gold has risen, and early gains have already been captured by institutional accumulation. But history shows that gold bull markets rarely occur in a straight line. The early phase is quiet, dominated by informed buyers. The second phase often sees much larger absolute gains as structural forces play out and broader market participation increases. Consider the 2001-2011 cycle. Those who waited for a perfect entry missed the majority of the gains. Today, central bank accumulation is accelerating, institutional repositioning is broadening, and the structural drivers, dollar system stress, real interest rate trajectories, geopolitical realignment are intensifying. We are still in the early to middle stages of this bull market. Finally, let's frame this in the context of the broader macro environment. Extreme government debt, constrained central bank policy options, geopolitical realignment, banking system fragility, and digital speed financial contagion risk create a perfect storm of systemic uncertainty. Smart money is not buying gold out of pessimism. They are buying because they understand history, structural dynamics, and risk management. Gold has preserved wealth for 5,000 years precisely because it exists outside any central authority, cannot be printed, and cannot be confiscated. In a world where systemic risk is mounting, these qualities are invaluable. The question now is simple. Will you position yourself alongside the smartest, most informed investors in the world, or will you wait until the move is obvious to everyone else? The window to act is open today, not next month. Take this seriously. Do your research. Assess the risks on both sides honestly. Make deliberate decisions based on evidence and analysis, not default inaction. By acting now, you align yourself with the flows of capital that will define the next phase of the gold market. By waiting, you risk missing the opportunity entirely. To conclude, gold today is not a speculative asset. It is strategic insurance, a hedge against systemic stress, and a vehicle for wealth preservation in uncertain times. The structural, technical, and geopolitical factors all point to continued accumulation and upward pressure. Central banks are buying at record pace, institutional investors are quietly repositioning, and physical gold is moving to the regions where economic power is shifting. The narrative is clear, and the evidence is compelling. Acting decisively now allows you to participate in a trend already underway and protect your wealth against risk most investors are ignoring. Remember, smart money is already positioned. The question is whether you will be too. This is your opportunity to align with informed capital before it becomes headline news and prices fully reflect the underlying accumulation. Think carefully, act deliberately, and secure your position in the asset that has preserved wealth for millennia. The time to move is now, while the structural forces are still working quietly behind the scenes.